Hello everyone. The subject which I'm going to discuss now is cost management for 6th semester BCom. And in cost management, the topic is need for marginal costing, arguments against and in favor of marginal costing. In the last sessions and all, we had discussed about what is marginal costing, how it is used, and in what way it is better than absorption costing. All this was discussed in the previous two sessions. In this session, we'll see in how are the ways that marginal costing is useful to the organization, why it is required, is it needed, all that will be discussed in this session. Need for marginal costing. Fixed expenses remain constant in aggregate amount and do not vary with increase or decrease in production up to a particular level of output. Just contrary to this, variable expenses increase or decrease in proportion to increase or decrease in output and remain constant per unit of output. So then this marginal costing will come to know like where the cost varies and what is the reason it is varying. When we compare this fixed and variable cost, we come to know that fixed cost remains the same at any level of output. Let it be for 50%, 60%, or 70%, whatever may be the production capacity, the fixed cost remains the same. Because once we incur the fixed cost expenses, in spite whether the production is going to be carried on or if the production is going to decrease or increase, irrespective of anything, the fixed cost has to be incurred. That is the reason the fixed cost remains the same. Whereas variable cost for every additional output, that is when there is increase in production, even the marginal cost also will increase. That's the reason, that is why it's called as additional cost. Marginal cost is nothing but additional cost. So when the production increases or when there is increase in production, cost also will increase. When why this cost is increased, till now we discussed that fixed cost remains the same at in any percentage of capacity. This cost is increased because of the variable cost. Well, what is variable cost we had discussed? Variable cost is the cost which changes as per the production or output. So if we are going to manufacture 10,000 units and right now we are manufacturing 10,000 units, we want to increase it to 12,000 units. So 2,000 increase will be there in the production. So for that increase of 2,000 units production, we need raw materials, labor, capital, all whatever is required, everything has to be increased. So this variation, that is because the production is increased, the cost also will increase. The cost which increases because of the increase in production is called as marginal cost, additional cost. So this we get a clear picture in the marginal cost. Fixed expenses per unit continue to vary with increase or decrease in production because these expenses remain constant up to a certain level of production. Thus, fixed overheads lead to different costs per unit at different levels of production. This um, statement clearly states that fixed cost per unit will change. How it will change is when the production increases, this fixed cost will be spread over to the number of units manufactured. So, what does it indicate is fixed cost per unit decreases as the production increases. For the variable cost, whatever cost is incurred, that will be multiplied to the number of units. Suppose 6,000 units and the cost administration cost you think 30 per unit. So 6,000 into 30 we are going to find out variable cost. Whereas this fixed cost irrespective of the number of units manufactured remains the same. So 1 lakh, 1 lakh for fixed cost is fixed up for administration. So this 1 lakh will be divided by the number of units. 1 lakh divided by 6,000, 1 lakh divided by 7,000. So as you go on dividing this cost by number of units, what happens is fixed cost per unit decreases slowly. That is the reason as the production increases, why your profit increases is fixed cost remains the same. Only the variation in the cost will be the variable cost. On account of this, a special technique known as marginal costing has been developed, which excludes fixed overheads entirely from the cost of production and gives us the same cost per unit up to a particular level of output. Thus, under this technique, fixed expenses are not allocated to cost units but are charged against fund which arises out of excess of selling price over total variable cost. So we need to find out contribution. What is contribution is sales minus variable cost. That in that contribution, you'll be having both fixed cost plus profit. Sales minus only the variable cost we have to take into consideration. That will be termed as contribution. So this can be found out only in the marginal costing. What are the arguments for marginal costing? Why it is required, why it is needed, we had discussed. Now we'll see how this marginal costing can be for as well as against. How it can be for is marginal costing is easy to understand. It can be combined with standard costing and budgetary control and thereby makes the control mechanism more effective. So when this marginal costing is quite easy to understand and this can be combined both with the standard costing as well as budgetary control. So this control mechanism becomes more effective. In the further forthcoming chapters, we'll be discussing about standard costing, budgetary control, how it varies and how we can calculate, how we have to estimate what are the different types of budget. All that when we study in depth, we'll come to know the differences. So for all this purpose, marginal costing is quite easy to understand. The marginal costing uses these techniques, the standard costing and budgetary control. Eliminating of fixed overheads from the cost of production prevents the effect of varying charges per unit and prevents the carrying forward of a portion of the fixed overheads of the current period to the subsequent period. As such, cost and profits are not vitiated and cost comparisons becomes more meaningful. In marginal costing, this elimination of fixed cost from the cost of production prevents like the effect of varying charges per unit and it is not carry forward for the next forthcoming or subsequent period. So it makes easier that here the comparison becomes very easy because only the actual cost which is incurred will be taken into consideration. Here the problem of over or under absorption of overheads will be avoided. Since in absorption costing everything is taken into consideration, variable cost, fixed cost, right from the beginning, right from the prime cost and factory cost, all the costs are taken into consideration in absorption costing. Whereas in marginal costing, all this is taken after the cost of production. Till the cost of production, fixed overheads is not taken into consideration. Henceforth, there won't be under absorption or over absorption of uh, closing stock. So it will give an accurate figure. So regarding the stock, there won't be any over or under absorption. This happens only in the absorption costing. So this marginal costing becomes quite easier. A clear-cut divisions of cost into fixed and variable elements makes the flexible budgetary control system easy and effective and thereby facilitates greater practical cost control. As it is bifurcated into fixed and variable elements, it's easy and very effective and thereby facilitates greater practical cost control. In marginal costing, the first and foremost step is bifurcating of fixed and variable cost. Since it is bifurcated, it becomes much easy and it facilitates good cost control. It helps profit planning through break-even charts and profit graphs. Comparative profitability can easily be assessed and brought to the notice of the management for decision making. This marginal costing is very useful for decision making since you know where there will be break even point. Break even point is nothing but there is no profit, no loss, no gain or no loss. So it's a point where the sales, whatever sales is sold, will be equal to the total cost. Whatever total cost is incurred will be to the total sales. So there won't be any profit, neither profit nor loss. So this break-even chart helps the management to take decision where the comparative profitability can be done. And since the decision making becomes easier by going through this break-even chart, at what level margin of safety is there and angle of incidence, all this we can go through this marginal costing. It's an effective tool for determining efficient sales or production policies or for taking pricing and tendering decisions, particularly when the business is at low ebb. Not only that, this becomes a very powerful tool for determining efficient sales or production policies. Based on this only, many of the production policies are framed, and here also pricing is taken into consideration. Henceforth, we can rightly tell that marginal costing is an effective tool which can be used for many purposes for the development of the organization. Then, what are these arguments against marginal costing? Till now, we have discussed the need and for and how it is useful, in what are the ways it is useful for the development of the organization. Now, let's see what are the arguments against marginal cost. Segregation of all cost into fixed and variable cost is very difficult. In practice, a major technical difficulty arises in drawing a sharp line of demarcation between fixed and variable cost. This distinction between them holds good only in the short term. In the long run, however, all costs are variable. So, this marginal costing, the main criteria is variable and fixed cost. It starts with this cost, variable cost and fixed cost. So, it's very difficult to segregate the fixed and variable cost. Segregation of all costs into fixed and variable is very difficult, and in practice, it's a major technical difficulty. So, like drawing a sharp line of demarcation between fixed and variable. So this is one of the main drawback of the marginal costing. In marginal costing, greater importance is attached to the sales function, thereby relegating the production function largely to a secondary position. Here, the importance is given only for the sales and not for the production. One should always remember that the sales can happen only when there is good production. When the production is neglected, then where will the sales come from? In marginal costing, they give undue importance only for the sales, and production is considered as a secondary position, which is not advisable. But the real efficiency of business is to be assessed only by considering the how much production is taking and production functions together. When all this is taken in consideration only, we can know like what is the position of the company and what is happening. Only by taking sales for everything here, the sales is the criteria. The main criteria taken is sales, which is not advisable. So production also has to be taken into consideration. This also is one of the main drawback of the marginal costing. The elimination of fixed costs from the valuation of inventories is illogical since costs are also incurred in the manufacture of goods. Further, it results in the understatement of the value of stock, which is neither the cost nor the market price. Here, since the inventories, when calculating the stock of inventories, they don't take into consideration the fixed cost, which is illogical. Here, whatever goods are manufactured or whatever the outcomes are there for all the products which comes out of the organization, there both variable and fixed cost is included. But in marginal costing, they neglect the fixed cost of the inventories, which is not logical because when the manufacturing is happening and that output or stock whatever is left out or whatever you are taking from the previous stock like opening stock, in all the stock whichever is there, both fixed cost and variable cost would have been incurred for the same, but when taking into consideration that is not taken, which is illogical. Pricing decision cannot be based on contribution alone. Sometimes the contribution will be unrealistic when increased production and sales are affected, either through extensive use of existing machinery or by replacing manual labor by machines. Another possibility is that there is danger of too many sales being affected at marginal cost, resulting loss to the business of inadequate profits. So this things has to be taken into consideration. In marginal costing, the pricing decision is based only on contribution. Contribution is sales minus variable cost. Only based on contribution, you cannot fix up the price. It is unrealistic. When the production increases, sales are affected. This contribution cannot be taken into consideration for fixing of the price. And when the existing machinery is replaced by manual labor, all this is neglected in marginal costing, which is not at all advisable for profit calculation, for pricing decision, so on and so forth. Although the problem of over or under absorption of fixed overheads can be overcome to a certain extent, the same problem persists about variable overheads also. Okay, fine. The problem of over and under absorption can be overcome, but even the problem persists not only in fixed overheads but also in the variable overheads. The application of the technique is limited in the case of industries in which, according to the nature of business, large stocks have to be carried by way of work in progress. Example, contracting firms. So, the application of the techniques is limited in the case of industries which, according to the nature of business, like large stocks have to be carried by way of work in progress. So, this is not taken into consideration. For example, contracting firms and all, they have a lot of work in progress. So it is carried forward for the next forthcoming year. This will be used, or in the particular year only, work in progress also has to be considered, which is not at all taken into consideration in marginal costing. So these are the arguments which is for and against marginal costing. So to conclude, we can tell that if marginal costing is used effectively, and by neglecting all the drawbacks, or by giving importance then and there wherever it is possible, and by setting it right, if marginal costing is used effectively, it is really a boon to the organization. In spite of the drawbacks, this marginal costing is useful for for making decision, for checking out the profit, so on and so forth. So this has to be used effectively, which in turn will give us a very good result. Thank you all. The references which I have taken is from the Aurora Himalaya Publishing House, and also Dr. K. Venkatramana from Seven Hills Books Publication. There's a lot of problems in this book regarding related to marginal costing. You also can refer to that. I hope this video has given a clear picture about need for and against marginal costing. Thank you all.